So we've all heard the word audit, right? And let's be honest, it usually doesn't bring warm, fuzzy feelings to mind. But what is it really? Why do we even have them? Well, in this explainer, we're going to break down how auditing is actually a fundamental tool for building something we all desperately need, and that's trust.
And this quote just hits the nail on the head. At its absolute core, auditing isn't just about crunching numbers. It's about building a bridge of trust in situations where, well, you just can't be sure. Okay, to really get this, let's put you in someone's shoes. Imagine this scenario. You've just inherited a massive 500-branch empire. Amazing, right? But here's the catch. Maybe you're not some business school genius. Maybe you just scraped by in school. And now you're sitting in the CEO chair, looking at this giant organization with this sinking feeling, who here is actually on my team and who's just looking out for themselves?
And that right there is the fundamental issue that auditing was invented to solve. It's what we can call the CEO's trust problem. It's a problem of distance, of scale, of not being able to be everywhere at once. I mean, think about it. You've got 500 branch managers. How can you possibly know if they're all playing by the rules? Are they working for the company's good or their own? Every single one of them holds a piece of your company's future in their hands. That's a scary thought.
Then you've got payroll. A manager sends you a list of, say, 21 employees. But what if only 20 people actually show up for work every day? Where's that 21st salary going? Now multiply that little scam across hundreds of branches, and suddenly you're losing a fortune.
And this is where things get really serious. Imagine a manager needs to make a big 15 crore purchase. They go out, find a supplier, and cut a deal for 14 crore. But they report back to you that the price was 15 crore, and that extra 1 crore, yeah, that gets kicked right back into their personal bank account. That is pure theft, straight from your company's profits.
So you're the CEO, and you're just drowning in all these what-ifs. You can't just blindly trust the reports your own managers are giving you. So what do? You call for help. You call in an independent auditor.
An audit is basically a formal, structured investigation. You bring in an outside expert, and this is key, someone with no connection to your management team. Their job is to dive deep into your financial records and figure out if the story they're telling matches what's actually happening in the business.
And this all boils down to what's called the three-party relationship. You've got management, who prepares all the financial reports. You've got the owners, that's our new CEO, who need to use those reports but can't fully trust them. And then you have the auditor, who steps in as the independent referee, checking management's work to give the owners some peace of mind. But what is this auditor actually looking for? What's the end game of this whole thing? Well, it's to deliver a verdict, a professional opinion on the truth of those financial statements.
Now, this is a really important distinction. True means the numbers are factually correct. You know, if the books say the company owns a building worth 30 million, it's actually worth 30 million. But fair is all about presentation. Is that building correctly shown as a long-term asset, or did someone sneakily classify it as a current asset to make the company look way more liquid than it really is? The audit checks for both.
And you know, this confidence isn't just for our CEO. Think about it. Shareholders, banks who are thinking about giving the company a loan, potential investors, even the government trying to collect the right amount of taxes, they all rely on that auditor's independent opinion. A clean audit report is a huge boost to a company's reputation.
Okay, so an audit sounds like the perfect fix, right? A magic bullet for the trust problem. But, and this is a really big but, it's crucial to understand that audits are not perfect. They have very real built-in limitations. This slide really lays it all out. An audit provides reasonable assurance, which is a very high level of confidence, but it's not absolute assurance. It is an expert opinion, not a 100% ironclad guarantee that every single number is perfect and that every last bit of fraud has been uncovered. And why not? Well, it's pretty practical when you think about it. For our 500-branch company, checking every single transaction would take years and cost an absolute fortune. So auditors use sampling. Plus, a lot of finance is based on estimates, like how long will a machine last? That's a judgment call, not a hard fact. And at the end of the day, the auditor has to rely on the evidence the company gives them. I love this analogy because it's perfect. The auditor isn't there watching the crime happen, so to speak. They show up after the fact and have to piece together what happened by looking at the evidence left behind, the receipts, the records. This evidence is persuasive. It strongly suggests what happened, but it's not final, conclusive proof. They're detectives building a case based on clues from the past. So now, let's just zoom out for a second. Auditing is actually just one specific type of service inside a much bigger professional world. To really understand it, we need to look at the whole picture, the world of assurance. Assurance is basically the umbrella term for any job where an expert is hired to give people more confidence in something. Yeah, it could be an audit of financial statements, but it could also be confirming a company is following environmental rules, or anything, really.
And within assurance, there are different levels of confidence you can get. An audit gives you reasonable assurance, that's the high level, stated positively, yep, in our opinion, these look correct. But there's a less intense job called a review, which offers limited assurance. Now notice the negative wording, nothing has come to our attention that suggests they're incorrect. It's a subtle difference in words, but it's a massive difference in the level of confidence you're actually getting.
Okay, so this independent watchdog is obviously super important. How does a company go about hiring one? Well, the process is actually structured by law to make sure the auditor is working for the owners, not for the managers they're supposed to be checking up on.
The law is pretty clear on this. When a company is brand new, the directors can appoint the very first auditor. But after that initial period, the power shifts. At every single annual meeting, it's the shareholders, the owners themselves, who get to vote and appoint the auditor for the next year. This is designed to make sure the auditor's loyalty is to the people whose money is on the line.
And so we end up right back where we started, with trust. An audit is probably the best tool we've got to build confidence in a messy, complex business world. It shrinks uncertainty, but it can never completely get rid of it. And that leaves us with a final, really important question for every investor, every owner, every CEO out there. How much uncertainty can you truly afford?